afternoon, everyone. Thank you for attending our webinar today. My name is Alyssa Douglas from Yash Technologies. We are a mid-sized global organization offering end-to-end business and technology solutions. And we're very excited to host best-selling author David Thomson on our webinar today. David is a recognized authority on growth companies and is here to share his insights on the essentials that mid-sized companies must do to get on and stay on a growth trajectory in these challenging times. David's research has shown that there are 8 management practices that are prerequisites for growth from 50 million to 1 billion, and we're happy to bring this information to you today. Please note that there will be a Q&A session at the end of the webinar, so please submit any questions using the Questions tab on the right side of your screen. And with that, I will go ahead and pass control over to David to teach us what we can do to grow our businesses.
Thank you very much, Alyssa. My journey has been growing billion-dollar businesses, and in the year 2002, during the last recession, when more companies were failing than succeeding, I had an in-depth passion to identify the quantitative success pattern of America's highest growth companies to beat the odds. Little did I think I'd be writing a best-selling book, and there is my second book is about to arrive in the bookstores in May, called Mastering the 7 Essentials of High Growth Companies. If you've read books like Good to Great, In Search of Excellence, Winning, and The 7 Habits of Highly Effective People, you would look at this research, which has extended over the past 6 years now, as identifying the quantifiable growth pattern of America's growth companies and the 7 habits of highly effective growth companies. Today we're going to talk about today's real-world growth situation and actions you can take to grow your business. My aspiration for you is to lay out a set of actions and a roadmap that will help improve your odds of achieving exceptional growth even during the most challenging of times. The identification of America's growth companies started with studying America's IPOs, or new public companies, since 1980, and as an update since the early work of Blueprint to a Billion in 2005, as of year-end 2009, there have been 11,000 new public companies brought to market since 1980. And the reason why I studied public companies is I wanted to understand the financial success pattern, and I wanted to, unfortunately, you can't find it with private companies and divisions of business units. What I did find is that only 4% achieved $1 billion in revenue, and they disproportionately, as of year-end 2009, account for almost 2/3 of the employment created, 2/3 of the market value created, almost $2 trillion in revenue as of year-end 2009, and, oh, by the way, for the government, 72% of the taxes paid. So clearly, the 4% are creating a disproportionate impact. What about the odds of failure? As of year-end 2004, 25% of these companies were inactive, and as of year-end 2009, that number is now 60%. So as you can sense, the odds of achieving exceptional growth from 0 to $1 billion in revenue are 1 in 20, and the odds of failure are greater than 50%. So clearly we're entering an era where one must either grow or go. Being in the middle is a very difficult and perilous situation. We defined growth based on revenue growth. Unlike many definitions of growth, which vary from price to earnings ratio, earnings per share growth, in my experience in sales and as a general manager, revenue is the most difficult line item for a management team to achieve. And these are the unique revenue growth patterns of America's highest growth companies. The line on the left is Google. It had a variable runway, it hit its inflection point, and went straight to $1 billion and beyond. It's on its way past 10. And there are other companies like Fifth Third Bancorp, which had a longer runway. When I looked at this pattern, I found there were 3 parts: a variable runway. I think in management we often called it a hockey stick or an inflection point, and then compounding revenue growth to $1 billion and beyond. And it was very interesting to see that there were no speed bumps, even through different economic cycles. When you normalize these curves, not at the year founding or incorporation, but at the inflection point, which turned out to be $50 million in revenue, you see that growth has 2 parts. The time from founding to $50 million, or the inflection point, is highly variable, the shortest being Google at 18 months and the longest being Fifth Third Bancorp at 150 years. The path to $1 billion, however, was very definitive for 6 and 12 years. They tended to center on that. Google, for example, pursued the 4-year trajectory to $1 billion, as eBay and Tractor Supply and other companies, like Williams-Sonoma, were on the 12-year trajectory. 80% of the companies that went through the inflection point pursued one of these 3 paths. It's been true since we identified it in '04, and it's going to be true for the next decade. And oh, by the way, we're finding this pattern to be global. SAP, one of our sponsors from Germany, headquartered in Germany, pursued their path to $1 billion through the middle of the 6-year trajectory. I thought the number one industry, being an electrical engineer, would be tech. It dominates our news every day. In fact, was I surprised to see that the number one industry that has created the greatest number of billion-dollar businesses since 1980 have been specialty retail stores. We shop at them every day, where they affect our life every hour, like Amazon, eBay, Starbucks, Best Buy, Williams-Sonoma, Tractor Supply. Then tech and financials and industrials and healthcare. And as you can see, over the past 25 years, America has not innovated enough in energy. The numbers on the right reflect changes as of over the past 5 years. You can see that industrials and healthcare are starting to grow, energy is growing, and the number of new billion-dollar businesses in consumer are starting to fall off. That being said, consumer industries are still creating the greatest number of billion-dollar companies. In '08, the year of our great meltdown, the real question I was trying to answer are that America's best management teams that are growing companies still achieving record revenues when the stock market was crashing, and I think a lot of management teams were feeling somewhat depressed. The great news is the companies that have, of the 4% that have passed $1 billion in revenue, 73% were achieving new revenue highs, and we track the companies coming to $1 billion. They average about 35 a year. Of the 170 companies expected to achieve $1 billion in revenue over the next 5 years, 99% of them were achieving new record highs, even in the most challenging of times. Another proof point that it is possible to grow by following the success pattern. This is a picture of those companies coming to $1 billion, and as you can see that the 4, 6, and 12 years, the 4 being in yellow, the 6 being in blue, and the pink or violet being in being the 12, continue to grow to achieve $1 billion in revenue. You can see that even through different economic cycles and markets, there are speed bumps, but the overall long-term trend is, in fact, exponential. When we count the number of exponential revenue growth companies, and I've been working with Standard & Poor's to develop tools to go back in time to count the number of growth companies, and growth is defined as size, 50 million in revenue up to as high as the S&P 500 members. We had 275 companies that were exponential or compounding revenue growth in 1993. That number peaked at close to 1,000 in 1999 and hit a low of 375 companies in 2003. We peaked at 900 in 2006. And oh, by the way, this is a leading indicator of the stock market. It peaked 1 year before the stock market peaked, and we've since been going down. In these cycles, from peak to peak, turn out to be 8 years, and in working with Standard & Poor's, we have found this 8-year cycle going back as early as 1965, and it's been 8 years plus minus 6 months. Our next peak is expected to be 2016, and as we bottom out in the number of growth companies, as you can see, these peaks are, in fact, moving down back to our long-term mean, which will be 800 companies. To become a leader for the next growth cycle, I encourage you to think about achieving revenue growth as the number of companies bottoms out in 2010 and early 2011, and we'll be in a confirmed economic growth cycle as the number of companies grow through the peak in 2016. The art of this is to create a recession-resilient growth company so that, in fact, you're one of the revenue growth companies independent of your size as we recycle down for the next peak in 2022. To give you a benchmark of the revenue growth characteristics between the two recessions, you'll find that the average management teams, in fact, that follow this pattern seem to have remarkable similarities. I was surprised at how similar these were. The average revenue size in the bottom of the recession as we entered 03 was $1.2 billion. They had a 44% revenue growth, 1,800 employees, and they added 750 employees at that point. Our companies were slightly greater in number, about the same size, about the same revenue growth rate, and we added slightly fewer employees. The net impact was we added 472,000 new jobs in our recession in 09 compared to the early part of 03. This is a number that's not been public that in fact proves that America's revenue growth companies of all sizes are in fact adding new jobs. Now you'll notice that one footnote, these numbers don't quite multiply out because these are the mean numbers, and there are some very, very large companies like CVS drugstores that added over 80,000 new employees going in through the 08-09 cycle. You may be asking, are we going to be growing consumer products? Because a lot in the news, we talk a lot about on the news, consumer spending will lead growth. In fact, I have great news for you. These are America's revenue growth companies at this point in the cycle, being led by energy, oil and gas exploration services, capital goods, tech, software and services, and technology hardware continue to play in the top 10. And as you can see, we have multi-billion-dollar markets in healthcare and biotech and life sciences, and they continue to place in the top 10. And diversified financials are not regional banks that led the previous cycle, but in fact companies like BlackRock, the NASDAQ that IPO'd, and the Chicago Mercantile Exchange. The headquarters for America's growth companies tend to dominate in California, New York, and Texas. This has been true over the past decade and appears to be true going forward. What has been very interesting is where are the headquarters for America's growth companies in the next 7 states. Arizona, Missouri, Virginia, Massachusetts, Wisconsin, Pennsylvania, and New Jersey are the next 7 states that host the headquarters for America's growth companies going into the next growth cycle. One question I had is, are America's growth companies actually growing through multiple recessions? Of the 375 in 03 that continue to grow through our current recession, I found 58. They tended to actually be somewhat clustered around healthcare, retail, and energy, and these are names of top 10 of those companies that you may recognize, and some names you may not. For example, NI Holdings is the former Nextel Wireless, Nextel International, that is one of the top wireless providers in Latin America and South America. And as you can see, these companies tell a story. People do fix their cars in down market cycles, and Whole Foods has continued to grow. They were on the cover of Investors Business Daily a few days ago talking about how they've re-engineered their pricing and value formula. McAfee, of course, is in internet security software. And Middleby actually makes the ovens for Panera Bread and Kentucky Fried Chicken. They're just crossing $1 billion in revenue. They have re-engineered the oven. So if you eat grilled chicken at Kentucky Fried Chicken, that grilled chicken is provided by innovative ovens by Middleby. And the Subway stores where you get your bread and your bread toasted are made by the bread ovens from Middleby. As I interviewed many of the CEOs that went to $1 billion through up and down market cycles, I looked for what I call the 7 essentials, or on a personal level, the 7 habits of highly effective people, being a fan of Stephen Covey's best-selling book. I looked for the common management practices that allowed these companies to continue to grow through all economic cycles, and I found 7 very unique ones that differentiated them from companies that failed. Like the 7 habits, utilizing more of these 7 essentials will increase your probabilities to grow. So I'm going to walk through these 7 and talk about investing in infrastructure as an 8th essential and lay out some actions that you can apply. Typically, most companies that I coach or talk to are missing 1 or 2 of these essentials. You may be doing 3 or 4, and the goal is to find a performance gap in the 2 or 3 of these essentials that your company may be underperforming, and take actions there. And if you focus those actions on the underperforming essentials, you will find that your growth will take off. The going-in hypothesis I wanted to test to create an exceptional growth company, whether you're at 50 million and doubling or $1 billion and growing of all sizes, is do you need to create a new market? That was true with names like Cisco and eBay and Amgen that created markets, Cisco, of course, being the Internet. But I found that over 60% of the companies didn't create a new market, they redefined a market. Nike redefined running shoes when U.S. Rubber was selling them for $5 by bringing out mesh on top of the shoe and a new insole. And Starbucks redefined the coffee experience when coffee is still a huge market. And, of course, Google redefined not only search but the advertising market. There were a broad set of companies that optimized the market, and you would know them as category killers in retail like Best Buy and Staples, and in the airline industry like Southwest Airlines and JetBlue. Optimizers tend to leverage supply chain investment to optimize the cost and quality and delivery and distribution of goods to consumers. Probably the best known for being an optimizer are Walmart and Costco. Companies that redefine their value proposition tend to have a high gross margin and redefine the experience and sell their products at a premium price. They tend to find a billion-dollar market segment and a multi-hundred billion-dollar market. Same is true for optimizers. When a company is focusing on creating, redefining, or optimizing a market, you need to focus on one. Oftentimes when I talk to management teams, they'll be on different pages. They'll either be redefining or optimizing a market, and it's important because to focus on this, because as you lay out your actions, it affects how you execute the other essentials. I use Starbucks as a wonderful example of defining higher order benefits. It seems to be a universal language that people speak. So in product, it's not about the beans or water. It's about customizing the coffee for you that makes you feel important. And you go to Starbucks to see the to have the friendly baristas customize your coffee so that you can indulge and escape. And Starbucks are everywhere so that you're in control of your time to indulge and escape. And probably the best-known slogan for Starbucks is they're the third place to home and work, offering that experience with comfortable chairs, tables, a place to read a book, or internet access from which you can do work with associates. I found that companies that deliver higher order benefits across product, location, and experience tend to have a higher gross margin and attract marquee customers and alliance partners, which we'll talk about. During challenging times, customers redefine their needs, and it's important that you form a customer advisory council and interview your customers to better understand how they're redefining their benefits, the benefits that you're providing. In terms of looking for high-growth markets, I was surprised to see that it is not about finding emerging markets, but very large multi-hundred billion-dollar markets like specialty chemicals, retail, healthcare, and technology are always being redefined on a market segment basis and go after a large mature market and identify a high-growth market segment within those large markets. The large markets may appear stagnant, but invariably there are growth market segments. Utilize the best management practices and technologies to stay close to customers. There is no one product that will take you to achieve exceptional growth. You need a portfolio. And uncharacteristically, partner with your suppliers. For example, Joe Scarlett, the former chairman of Tractor Supply, reviewed Tractor Supply's business plan with their suppliers to better differentiate their products to compete with Walmart as the #1 retailer in rural America. And finally, import ideas from other industries. A great source of innovation by importing ideas. Tom Stenberg, for example, imported the shopping cart into the office products business when he founded Staples, created basically the grocery store for office products, and that's still true today and is propelling Staples' growth. The third essential I call marquee customers. Not all customers are created equal. There are customers that absolutely love your company, and they do three things for you. They consume a lot of your product. They are the source of exponential revenue growth on a per-customer basis. They help you shape your value proposition, help you define your higher order benefits in terms that customers can understand, and they are a lighthouse reference for you. They actually will help your company sell to other customers. Now, customers who sell to other customers have a huge effect on your company. Number one, they cut your sales cycle in half. Number two, they cut your SG&A in 2/3. and 3, that give you industry credibility with them and spread the word in the market to other customers. Customers love to hear about the benefits from other customers rather than you. It doesn't cost money to have customers sell for you. This is probably one of the most important actions you can take to help you grow your business. This is the story of Cisco. I went out and talked when I was working on the original research to identify exponential growth. Many of my audience members asked me, David, what are the microeconomics that cause these growth curves to happen, compounding growth? In fact, it is on a per-customer basis. And I went out and talked to the Fortune 500 CIOs and asked them to go back over 15 years and look at their vendors. And whether this be Cisco or any of their other suppliers, you found these compounding revenue growth companies. In 1989, Terry Edger, who I interviewed, the original vice president of sales, sold routers to campuses of this large company in Phoenix, and then Florida and Austin, and finally in 1993 ended up at the head office in Chicago of this Fortune 500 company. And at the time, the CIO realized they need to tie their campuses together and create a global IP network. As a result, they built a lab and tested all of Cisco's products. And today, Cisco doesn't just take customers to San Jose. They take them to Motorola in Chicago, where Motorola is still testing many of Cisco's new products as they roll them out into their global IP network. These same revenue curves would be true for Starbucks customers based on frequency of visiting a store, the size of the coffee, buying food. It's all about compounding revenue growth on a per-customer basis. So one of the actions I suggest many of you take is go find your most important customers and look at and identify if you're having compounding revenue growth per customer, and if you're not, problem solve around that set, because this is absolutely critical for your company to grow. The fourth alliance to help revenue growth is leveraging Big Brother alliances to break into new markets. Probably the most well-known and iconic of this effect is when a small company partners with a big company, was when Microsoft provided the operating systems for the IBM PC. Big brothers or large corporations cannot invent it all, despite maybe the perception that they can. They often have critical portfolio gaps, and they look to license. As Procter & Gamble utilizes Nancy Bailey Associates to license their brands like Mr. Clean and Scope to have little brothers make products for them. For example, all the Mr. Clean mops and erasers and gloves are all made by smaller companies under the Mr. Clean brand. Little brothers, besides the supply side, get access to market, and most important, get market intelligence on the direction of customer demand. If you're a small company looking for a Big Brother alliance, focus on filling a critical portfolio gap for a Big Brother alliance partner. Now, when it comes to returns, exponential or compounding revenue growth companies, not all of them make money, but most do, and most tend to exhibit compounding earnings that drives compounding market value creation. When I've been working with Standard & Poor's on the stock funds for utilizing this quantitative pattern of the 250 variables that drive market share value, industry turned out to be in the bottom 50. It truly is all about the math of revenue growth and earnings growth. And by the way, just as a little joke, you might have thought these curves were Google, but in fact they're very similar. Fastenal is in the hardware business, but in the construction supplies businesses. Some of the latest research we've been doing this year is identifying the factors that drive market value of America's growth companies, and there are a unique set of factors. And we've been incubating a new star system, a la what you would see from S&P, Value Line, and Morningstar. And the first star that drives shareholder value is revenue size and revenue growth, followed by being cash flow positive as early as $25 million, and being cash flow positive as eBay has all the way to $8 billion and beyond, and Cisco. Capital efficiency. As your company is investing in assets, how well, or IT infrastructure, are you leveraging those assets to achieve high return on those assets? Employee productivity and growth is the addition of employees. Companies that are growing tend to be hiring. As I mentioned earlier, they tend to also have growing revenue and profit per employee. Industry rank is defined as your company's ability to be number 1, number 2, or number 3 in revenue growth rate. Now, in the early days when I listened to Jack Welch, Jack would always say, be number one or number two in your market to achieve the most profitable position. But when you're a smaller or mid-sized company, or even a company at 2 or 3 billion in revenue, it's really difficult to be the largest. And what I've learned is not about the size, it's about your revenue growth rate. So my coaching to you is you benchmark your company's growth, rank your company against others in your industry to make sure you're the fastest growing. And by the way, you don't need to be the smallest to be the fastest growing. Large companies can outgrow smaller companies. In terms of profit performance rank, measure your profit and cash flow as a % of your sales. Down the home stretch, it is about consistency. Companies that are growing and continue to grow on a predictive basis tend to be consistent about it, and they are most likely to continue to grow. Companies with a volatile track record and fundamental performance tend to generate negative downside surprises. Many of the systems do measure momentum as measured by stock price. This is not a daily momentum measure, but a long-term momentum measure, and it tends to measure the management team's ability to communicate to Wall Street and institutional investors. Each of these stars are weighted and gives you an overall score. Companies that tend to rank high tend to outperform the stock market. As an example, the companies over $1 billion in revenue, we've created a blueprint index. And as you can see that since 1993, it outperformed in the last growth cycle. In the last recession, these companies maintained their market value. And in the 03 to 06 growth, they actually led the overall stock market higher. In other words, the implication being going forward that if the stock market's going to go higher, it's going to be led by America's growth companies. And as you can see, over the 10 years, those companies have tended to maintain an overall trend. During the last cycle, the valuation of these companies was richly rewarded in contrast to other value companies. And as you can see, America's greatest growth companies have returned back to the trend line and are starting their climb back. This may sound, being a CEO or a management leader of a growth company may sound like a lonely job, and it's overwhelming. There's a lot to do, and there is no doubt that there's a lot to do. And what I found was a very unique leadership team. I call them inside-outside leadership pairs. Bill Gates was outside-facing, focusing on the external essentials, the IBM Alliance, discovering new markets, and the technology innovator. John Shirley arrived in 1989 from Tandy, a marquee customer, as Mr. Insight. It was John Shirley who structured Microsoft into 4 lines of business. I interviewed Joe Scarlett, Mr. Outside at Tractor Supply. Jim Wright was his Mr. Inside. Joe would spend 150 days of the year on the road innovating in customer alliance relationships and innovating in their higher order benefits, and it was Jim that focused on innovation and became the masters of exponential returns. Leadership pairs tend to dominate these companies. If you're leading a company or growing a company, find your other half. Many companies tend to have 1 or 2 people who are both inside-facing or outside-facing and don't really have an explicit complementary pair. They're often perceived by the management team or customers as a pair. As you can see visually, the chemistry between an inside-outside pair is one of trust and one of friendship, and they tend to start a sentence and the other one can complete it. They have a like mind. These pairs have continued to grow America's growth companies like Cerner and Garmin, and they do turn over, as Meg Whitman was outside and had multiple COOs. I recently interviewed the management pair from HCL, and they have in fact implemented inside-outside leadership across their company globally. So their vice president of sales is an outside-facing account exec, and their vice president of delivery is an inside-facing, and they are in fact a pair. Inside-outside pairs tend to have 3 leadership components: a focus on relationships and products, which is outside and inside. They drive to innovate and explore. They tend to lead and manage forward for growth, looking out 6 months to a year. And they tend to be able to multitask and manage all 7 essentials. Down the home stretch, when I looked at companies that were exceptional growth, I looked at the boards, wanting to better understand if in fact the 7 essentials address board governance. I found that companies that struggled in the long term tend to have boards dominated by management teams and investors. And boards that companies grew tended to be balanced with a community member for the greater good in recruiting talent, alliance partners and customers, and a CEO who had grown ahead of them. and in many cases, CEOs who have been to $1 billion in revenue, and they could be even sitting on the board of small companies. For example, today, Tom Stenberg, the founder of Staples, still sits on the board of PetSmart. Charles Schwab in the early days sat on the board of Siebel Systems when Tom Siebel basically had zero revenue. And I have been using these models as I've been applying the 7 essentials to my own small business. If you're a business unit, I tend to find business units tend to be governed by investors and management team members, i.e. a group vice president and a CFO. And the key here is to create a virtual board and bring in outside advisors to help you set your strategy. If you're a private company, I tend to see that boards are dominated by family members, and the art of this is creating an advisory board to bring in outside advisors. 7 essentials. As I scored the companies that grew, I found that over 90% of America's highest growth companies use 5 or more of these 7 essentials. Your company may not use all of them, but utilizing 5 or more will truly turbocharge your growth. If you're using less than 4, I encourage you to find the 2 or 3 that you're underperforming on and focus on actions to close the performance gap. As I interview CEOs and management teams that have grown through the past 3 years, I would like to spend a few minutes on actions you can take by essential, and these charts will be available on the Yash website so that you can, at yash.com, download this list. First of all, to focus on delivering way better value to customers during challenging and recessionary growth times, redefine your customer benefits. Invariably, customer benefits are being redefined, and they speak a different language and they perceive a different set of needs and benefits, say in 2007 during the last growth cycle versus today. Focus on the value zone as HCL has done, which is really the intersection. As the value zone is defined as the intersection between the customer's needs and what the supplier can offer and what the competition provides. Innovate and test. Fail often, fail fast, fail cheap, and look for successful implementations. Do not overinvest in order to grow. It's quick and dirty. Pilot to accelerate customer feedback, especially during changing market dynamics. In terms of the next 3 revenue growth essentials, probably the most important is forming a customer advisory board. Over 80% of the companies that I talk to don't have a formal customer advisory board or boards. One that I'm coaching right now, I very suggested go. They found they had a group of great healthcare institutions down in Florida. They found their 5 best customers, and they grabbed a hotel room, and they spent a day talking about, number 1, what are the benefits that the customers are perceiving today their company is delivering. 2, what are the customers' unmet needs going forward? And the third part of the day was spent on the roadmap to meet their unmet needs. These are customers that love your company. They want your company to succeed. They want to share all their perspectives with you. Getting their feedback is extremely important to plotting your growth going forward. And encourage them to sell for you. And it's a very easy conversation. They want to spread the word and reinforce their buying decision to associates in their industry. If you're looking for a Big Brother Alliance partner, try and define a concrete portfolio gap in their portfolio, especially during today's times. Large companies cannot invent it all. When it comes to managing the P&L for your business and leadership, companies do streamline core businesses. Unlike many management teams that cut expenses evenly across all functions, they really do go and study their core processes and streamline them. They're often investing in supply chain, as Aruba Networks has done from SAP, to optimize their supply chain. It's a great time to optimize your processes when volume and demand is lower to get ready for the next growth cycle. They strive to achieve positive cash flow. And back to the STAR model, we've seen that companies that have positive cash flow enable them to reinvest in order to grow. This may sound, again, like a daunting task, but this is when inside-outside leadership pairs really step to the plate. This is really dividing and conquering to both grow and manage your cash flow and streamline your business at the same time. It's a great time to restructure your boards for the next growth cycle to really put a set of board members on that will help you expand into new markets. As I've talked to CEOs who've been growing in management teams through these challenging times, I find they are investing in infrastructure. They may be assets, they may be hiring people, or they could be IT infrastructure. They tend to invest in upgrading their basic core systems. And I put in brackets here, returns and leadership, to correspond with the essentials that this investment tends to relate to. Companies are redoing their supply chain, which is allowing them to re-engineer their value proposition, the market they're going after, and improving gross margins. Or they're investing in market intelligence systems to better understand and manage marquee customers, alliance partners, and improving their gross margin, because oftentimes they're redefining a market. And they really need market intelligence systems if you're following in the footsteps of Nike, Starbucks, or Google. Companies often, like Exojet, have real-time metrics are required to manage demand and working capital. If you're in the corporate jet business and your assets are on the move, you need real-time metrics to manage your business. And this characteristic has been true across almost all industries these days. Aruba Networks in the high technology business, competing against Cisco, has invested in processes to speed new product development to get to market from beginning to end. Hence, it is really turning over its value proposition with new products. In fact, I'm finding that America's growth companies are spending in the range of 15 to 17% in R&D right now, really focusing on retooling their product line for the next growth cycle. Companies, as I've gone through my life, I've have great benefits of being coached and have gone through the 360 feedback process with a personal 360 feedback scorecard. And over the years, we've created a 360 feedback scorecard for your company, and we call it the 7 Essential Scorecard that you can take. It's very confidential, and you can click through this online scorecard, which is free, and each of the ingredients for each of the 7 essentials and get an overall score. You can take it, your management team members can take it, and by the way, you'll probably get slightly different scores, because I found most, and when I started this journey, most view growth through the lens of their own experiences. So even though they're reading the same statements, they may evaluate them differently. Here's an example of what you may see. If you're red, your essential is underperforming. If you're yellow, it's average in performing with a score of between 3 and 3.9. And if you're green, between 4 and 5.0, you're overperforming. And the goal is to get to 5 or more of the 7 essentials in green. Here's an example when we give management team scorecards for our workshop to get a top 10, bottom 10. And here's a particular case study of a company that was not executing well on their alliances essential. And as you can see, also in investing in infrastructure, they were lacking the systems in order to propel their growth going forward. And you can particularly see that some of the management team members were ineffective in that they were not getting access to delivery of information in a timely basis, or in some cases, companies, especially in the financial services industry, weren't, or healthcare, getting information necessary to stay compliant with new government regulations. Here's an example of, I asked the team at Yash for a customer example. Vistaprint. Vista is on the path to $1 billion in revenue. They recently crossed at year-end 2009, $500 million in revenue. And despite today's challenging times, Vistaprint is a wonderful example of a company that is achieving compounding revenue growth independent of the economic cycles. They did invest in HR and ERP systems at 200 and recently is at 200 million a couple of years ago, and as recently as last year. And it's a perfect example, as you can see in the financial pattern, of how management teams are achieving consistent revenue growth and reinvesting in infrastructure in order to continue that growth journey. If you follow this growth pattern and Vista continues on this pattern, you can see with a pretty good prediction that they will achieve $1 billion in revenue in the next 2 to 3 years on the outside of the 6-year trajectory. For companies that may be growing and wondering, okay, how do I plot my path forward? This is a methodology we've created. Here's a case study of a company at $250 million in revenue. And really, when they think about their plan, we found 3 or 4 options. The outside white line is, in fact, the revenue growth projection that Goldman Sachs had placed on this company. The white line to the left on the inside of the 12-year trajectory is, in fact, the planned budget for the company. And, of course, when you present these trajectories, I haven't found a management team that decides that they don't want to grow even faster and they want to get there a year or two sooner. And the two right lines to the left on the outside of the 6-year trajectory, in fact, became the aspiration for this company to grow. As you can see, the effect looking out at $1 billion when you're $250 million is quite large. But if you look back at the next year, the impact on revenue growth is actually quite small at an absolute dollar perspective. The key learning here is, do you think about your growth to $1 billion and beyond? You need to take actions today that will enable your business to achieve exponential growth in the future. It's not just about making the quarter, but it's about starting new business initiatives, new product lines, expanding into new markets, working with alliance partners to grow this quarter and looking out 12 months. This is a picture of the online scorecard that you can take to measure your essential performance that will help you achieve exponential growth, just like Vistaprint. You score 1, 2, 3, 4, 5 with each of the ingredients of each of the essentials, which gives you an overall color score for the essential, and the goal is to get to 5 or more of these in green. If they're not all green, don't feel too concerned. Most of the company, over 2,000 companies that have taken these scorecards, tend to have an average score, which is a great opportunity for you to focus on the specific actions to turn them into green. And, of course, there are times when we give management scorecards where the team is not on the same page. And this is where you find people come to a meeting and they leave and they always don't agree after the meeting because they're having a discussion, but they're viewing solving the problem through different lenses. They may think they're agreeing, but they seem to be having a conversation with the same terms, like new products. Is a new product an extension of the core business, or is a new product for a new market to truly grow the top line incrementally? Oftentimes, teams that decide on R&D are using the term new product and have different implicit meanings to what they mean by those 4 simple words. And finally, down the home stretch, to create a roadmap, you can. There's the new book coming out in May. We'll have these templates, or you can do this manually, or of course we do workshops. But it is about problem solving by essential. So what we've done here as a methodology is taking actions on a per essential basis. For example, in this case study, doing a win-loss analysis in your value proposition that leads to pilots over the next 12 months to get to new lines of businesses. And oh, by the way, these essentials tend to get linked. So for example, getting a CEO on board with a new Rolodex of new customers and a view of new markets helps redefine new business models based on the win-loss analysis. These linking of the essentials, in fact, create leverage. And here at the bottom, you can see that the need to invest in infrastructure is timed with the execution of the 7 essentials. So as your business model becomes more complex, you're going to need to build financial and HR systems. As we've done roadmaps for companies, we really found that the synergy of linking the essentials is the essential ingredient for management teams to get more done by working less. In terms of next steps, we've assembled a web page for you on yash.com so that you can take actions to grow your business. There is a case study there on Vistaprint as one example of a growth company, a link so that you can take the 7 essential scorecard. Many of the actions in this presentation are in a PDF file that you'll be able to download. It'll be there in the next hour on the website or two. And there is a series of articles on businessweek.com as a special highlighted session, 7 articles with actions you can take as excerpts from my new book, and also video interviews with Patricia O'Connell from businessweek.com. And if you need a link to my website or my email address at blueprintgrowth.com, that link will be there as well. I hope that this 45-minute discussion has given you some ideas and actions that you can take to grow your business. Thank you very much.
Thank you, David. Now we have a few minutes for some questions and answers. As I mentioned at the beginning, you can use the questions tab to the right of your screen to submit any questions. I see that there are a few. So David, I'm going to go ahead and ask the questions. And the first question is sort of a multi-part question. The 7 essentials are inspiring. You mentioned the essential having marquee customers that sell for you. We're a manufacturer with a loyal customer base of both distributors and end users, mainly in the Midwest. you mentioned adding customer advisory councils. Should we be doing this with our distributors, our end users, or both? How can we leverage all of our customers? Can you give an example of how to propel an initiative like that? What have other companies done in the past?
Wow. Okay. So it can be confusing at times when a manufacturer is selling to, say, retailers, and those retailers are selling to customers. In fact, you need to have a two-tier customer advisory council structure. It is important that you have a customer advisory council with retailers. Now, when you do it, you may structure those advisory councils with retailers from different parts of the country where they may not compete, or you may set them up regionally so you can get their advice on how to best supply and partner with them to optimize your business and theirs to sell your products. But that being said, it is important to set up a customer advisory council of end-user customers for your products. For example, Build-A-Bear, their customer advisory council are children who talk about the kind of bears they want to build. If you're in the office products business, it's important that you find end users who are buying your products for their home office and better understand where they're going and their needs for the home office so you can best design your goods, furniture, or electronics, and then take and partner with retailers to do those customer advisory councils, and then bring those new insights both from an innovation and product design, but also into your retailer customer advisory councils.
Great. Okay, we'll move on to the next question. Is there a particular industry that you found that was more effective in achieving exponential growth?
I found the technology industry has been, over the past 20 years, a consistent outperformer. They tended to be cash flow positive as early as $25 million, as Cisco was. They tended to have the highest market value at $1 billion in revenue, all industries being equal. Another industry that's generated a disproportionate number of profitable billion-dollar companies is healthcare. Financial services has had cycles. It's been very profitable and a source of billion-dollar companies through the last cycle, but with the heavy regulation right now, that number's dropping off. And then, of course, down the home stretch is consumer. While consumer spending is down right now, companies like Zumiez and Buckles continue to grow to $1 billion and beyond in the consumer space. It is probably the number one economic sector for the greatest number of billion-dollar companies, although their value at $1 billion in revenue is less than those at tech.
Okay, great. Got a couple more here. Can you give examples of how to create an incentive for customers to sell for you? We're finding this hard to do without giving up a great deal of time, money, or effort. We have a complex product, which is tax and revenue administration, that we sell to government agencies.
Within your set of customers, there are always passionate customers who really love your company. They're excited about your product. They want to be at the forefront of requirements, and it's about trying to find and screen for those set of companies. They may be 1%, 2%, 5% of your customers who are very passionate about what you do, and they really want to stay at the forefront because they're trying to grow their business and they need your company to come up with new capabilities. They want to invest their time with you so that you'll meet their needs as a priority customer. There's greater leverage for them by you meeting their leading edge needs than there is than trying to get a price discount. If you move further down into the mainstream customers who aren't as innovative, they'll tend to ask for a price discount. So, for example, to give you an example, I'm starting my stock fund, and I started my board of advisors, and I'm not paying them to be on my board of advisors. And what they really wanted was to invest in the stock fund, and what I offered them was most favored nation clauses so that as we get institutional investors, they will get the very best set of fees equal to the institutional investors. And that's all they wanted. They didn't want any fees. They didn't want a discount. They just wanted to know they were getting the very best treatment when we get larger customers. And that is the kind of business model that, to illustrate, if you can find those customers amongst your set, will really be the most earnest in wanting to invest to help you to grow in a very selfish way, selfless way.
Okay. Here's the next question. We are at the $60 million mark. How do you balance having a positive cash flow and knowing when it's the right time to take the leap into investing in technology? I feel that if we don't make a jump into our operational infrastructure, we may end up playing catch up with our competitors.
So 60 million is right in the middle of the inflection point, and the year after the inflection point is when most companies' revenue growth rate tends to peak that year or the year after. So you're really in a really high-pressure situation. It's like the space shuttle taking off and hitting escape velocity. All the engines are firing, and it really is a balancing act. Your company should be, if it's not cash flow positive now, should be becoming very cash flow positive soon. Companies that, looking forward, tend to have to invest now in order to grow, tend to scale their investments in phases in order to get their infrastructure built and quickly add to that infrastructure as they grow. Delaying infrastructure or asset growth or investment to be a sort of a big lump sum investment later tends to choke the management team because you're multitasking and you're focusing on growth and you're focusing on cash flow and you're focusing on investing. The art of this, to get back to how to execute it, isn't just financial engineering, it's leadership engineering, and you need to have that inside-outside leadership team to balance this. And it is about prioritizing and looking for high impact against your investments. When we look at the stock funds, we find the characteristics of these companies have a high sustainable growth rate. We're actually finding positive cash flow, and they're investing anywhere from 20 to 40 to 50% of their cash flow in reinvesting to grow, particularly through the inflection point.
Great. I think that is all of the questions that we have this afternoon. So that brings us to the end of our webinar. Thank you, David, for your time and willingness to share such valuable information and your experience. And thank you to all who participated. We're glad that you could join us and hope that you found the webinar to be helpful. Before we log off, I'd like to just let you know that you'll be getting an online evaluation form at the end of the webinar, and your feedback is very valuable to us. So please, if you would, take a minute to fill out the survey. And also, of course, feel free to contact Yash with any questions or for further information on the webinar. Thanks a lot.
Thank you.